Whether you like it or not, global conflict will impact your personal finances. Whether it be any pensions that we hold or investments in stocks and shares, ISAs, any tensions that might be increasing between different countries will cause volatility for anything that you're invested in. But of course, the big question is, how bad does it actually get? And how long does the volatility last for? And is it every single company on a stock market that falls in value when this happens? And the whole purpose of this video is to unpick and answer those questions and see if we can learn any lessons from the past. So before we answer those questions, let's start with the why to begin with. You might be asking yourself the question, why do stock markets even wobble when conflict is on the horizon, even if it's very unlikely for it to happen and it's just a whisper at the moment? And the first reason for this is that markets are extremely efficient. They're effectively taking into account all of the expected or likely events over the next 5 years. They are all accounted for in the current level of stock markets. They're not just considering all past information, they're also thinking about the future and what's likely to take place. And when we think about those companies that are listed on those stock markets, remember, they are very likely to be globally selling their goods. They might be based in one country, but actually have customers across all of the rest of the globe. Equally, even if a country is only selling their goods within the country that they're based, they might be getting their materials and their services from other countries. And conflict tends to disrupt those kind of things. And ultimately, a company's profit outlook might change if they are going to struggle to sell or source the ingredients that helps them run their business. And how that would work in practice is that we would tend to have a big investment manager or someone who is running a really large fund, and they will need to make the decision of whether I should carry on holding shares in this company, knowing that their future outlook is not as rosy as it once was. Maybe holding cash or bonds becomes much more appealing. And ultimately, when we are in a market where there are more people selling a share than buying it, that is what causes stock markets to fall. So let's take a look at the past and see exactly how things have gone when conflict has occurred. And we'll be considering different events here, like of course World War II, all the way through to the most recent kind of Russian invasion of Ukraine. And luckily, I'll be making use of some great data put together by Nedbank here, who basically looked at the Dow Jones Industrial Average. Now, the reason this is such a useful stock market to use is that it's been around a really long time. So we can look back over many years. The other benefit, of course, is that it's made up of really large, globally focused companies in the exact same way as many of our pensions or investments will be. And so let's cast our minds back to 1939, which is, of course, when Germany invaded Poland, and this was officially the beginning of what we now refer to as World War II. Now, considering this was such a large-scale event, you would have expected that global stock markets seriously plummeted. Ultimately, there were huge concerns or worries that the next number of years were going to be dominated by conflict, and hence companies were going to really struggle. In 1939, what we can see is that the Dow Jones fell by just 4% over that year. Now, importantly, at the point at which conflict was confirmed, I would have expected that that market would have fell significantly more than by just 4%. But what we're considering here is basically a year around the event. And so what we can see is that even though there is an initial overreaction, what actually tends to happen quite quickly is there can be a recovery or the dust settling, where stock markets and investment managers start to see a way through the conflict and potentially how the shares and the businesses that they're holding could continue to earn a return. And then again, if we skip forward to 1965, which is when the Vietnam War seriously escalated, again, this could have been another big reason for stock markets to be very volatile. But during that time, markets actually still increased by just shy of 9%. And most recently, of course, Russia invading Ukraine. During that time, the Dow Jones fell by just over 1% in total. And if we look at these three pretty major events, as well as the other major market movements that I'll put on the screen right now, what we can immediately see is that actually the reaction from stock markets is not as bad as we might have originally feared. Markets tend to be incredibly resilient, and those that are patient and can stay the course tend to be rewarded really well. Now, the key message here, of course, is that we are considering a relatively well diversified portfolio here. So the Dow Jones itself is made up of 30 of the largest companies that are listed in the US. And therefore, we are removing some of the idiosyncratic risk, the risk that a single business might seriously suffer during conflict. And the same should be true of any investments that we hold today, whether that be in our pensions or stocks and shares ISAs. Make sure that you are holding something that is really well diversified, not only across the globe, so benefiting from different countries, but also potentially making use of different types of investment. And primarily, my mind goes to here equities, bonds, and shares. You might even be asking yourself the question, why have these companies been so resilient during these times? And one of the main reasons is that companies are incredibly agile and tend to be quite resilient in producing a profit and return over the longer term. We live in a highly capitalistic society, and therefore companies tend to react so that they can carry on producing their goods for our nations. In addition to that, governments also have many tools at their disposal, ultimately to support the economies with which they are trying to help. In addition to this, certain sectors actually tend to outperform during times of conflict. And primarily, we can be thinking here of stocks that are based in defense companies who might be producing equipment or tools that might get used in war. In addition to that, energy and utility companies tend to perform relatively well as things which are absolute staples of society and continue to be required. So, what are the lessons that we can learn from history here? Stay really well diversified. Don't panic too much when conflict occurs. It always feels like this time is different than the last, but history shows that markets go through periods like this. Make sure you're invested at the right level of risk. Try and keep your costs as low as possible.